All right, hi, good afternoon. Thanks everyone for joining us. Today, using Valueline's digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After the presentation, as mentioned, we have allotted time for questions and answers. To start, for those joining us for the first time, I want to provide a brief overview of who we are at Valueline. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Valueline Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Valueline's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Valueline has no investment banking business with any company, including the 1,700 that are included in this service. Valueline does not execute trades for its subscribers, and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As part of the formal presentation, I thought it worthwhile to include an overview of the economic situation, as well as the Valueline Research Department's view of the stock market. Obviously, this could help us with our search for a stock to buy right now. The following content was prepared by Harvey Katz, Valueline's chief economist. It appears to be coming together for the nation's economy as the old year winds down. This is not to say we are off to the races. The upturn, in its ninth year, has too many holes, particularly on the wage front, and too much underutilized capacity for that to be the case. Still, we sense there is enough momentum in place for GDP growth, which we forecast will average 2.3% in 2017 and approach 3% in 2018. That said, this year has been unnerving at times, with a weather-impacted start, a spring comeback, which then was endangered by late summer hurricanes, and a likely solid close. In all, the 12 months should turn out fairly well. In fact, the estimated 2.3% GDP increase this year, up from our 2.1% view 3 months ago, also would be notably better than the 1.9% gain tallied in 2016. Meanwhile, our 2018 model projects further strength in key consumer and industrial markets, higher infrastructure spending, and modest benefits from tax reform. Behind this optimism are a steadying in motor vehicle sales, recent increases in housing starts and building permits, further growth in incomes, developing strength in industrial production and factory utilization, solid job growth, and a falling jobless rate. True, the economy isn't firing on all cylinders, as wage growth is tepid, inflation is mostly running below Federal Reserve targets, and household debt and consumer loan delinquencies are rising. Still, with the upcycle isn't memorable for its strength, it does get high marks for durability. Meanwhile, not only has the bull market for stocks persisted, but the last year has brought new gains as optimism fueled by the potential for lower business and individual tax rates, the ongoing growth in company profits, and surprising resilience on the economic front have increased the attractiveness of equities. In all, the year-to-date gains for the Dow and the S&P 500 are around 20% and 17% respectively, while the NASDAQ boasts an advance of about 28%. And this is on top of the prior 8 years in which stocks have enjoyed a number of double-digit annual price increases. Of course, such continuing gains, for example, the Dow has almost quadrupled from its 2007 to 2009 financial crisis lows to its recent lofty perch, leave little margin for error, be it on the economic, legislative, global, monetary, or earnings fronts. Fortunately, for those long equities, the economy appears to be on sound footing, with steady, low inflationary growth seemingly in the future for at least the next year or two. Congress looks to be making progress so far in its tax reform efforts. Global growth, albeit fragile, and perhaps affected by some political headwinds in Europe. But the Fed remains accommodative, and the earnings uptrend clearly is continuing. In conclusion, as noted, the stock market's relentless rise and the consequent increase in PE multiples to now about 20 leaves little room for disappointment. Thus, while we think stocks can still head higher, the road to such possible gains may prove challenging. As such, a careful approach to equities is warranted, with particular emphasis on the selection of quality names with supportive earnings, and for those interested in income, well-covered dividends. Now that we have a firm base in regard to the economy, stock market, and our outlook, it's time to find a stock to buy right now. As you can see, I am currently at our homepage, valueline.com. On this page, you can access, free of charge, daily market commentaries, as well as general interest articles that are written by our analysts. Examples of such content are economic releases and quarterly earnings supplementary reports on the 30 components of the Dow Jones Industrial Average. I'm now going to sign in with my username and password. This brings me to the welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head to our investor tools, as well as the home pages for our monthly stock selection services. That said, for this presentation, I want to start at the dashboard, which is the main landing page for subscribers. As Harvey Katz mentioned in the market commentary, the stock market's relentless rise and the consequent increase in PE multiples to now about 20 leaves little room for disappointment. Thus, while we think stocks can still head higher, the road to such possible gains may prove challenging. As such, a careful approach to equities is warranted, with particular emphasis on the selection of quality names with supportive earnings, and for those interested in income, well-covered dividends. I think Harvey's view is quite reasonable, and I'm going to use it as my baseline for finding worthwhile stock candidates. Let's now take a look at how the 1,700 stocks in the Value Line Investment Survey are being valued at this time. To do this, the Weekly Summary Index is a good place to start. This 40-page PDF can be accessed via the quick link. As you can see in the box on the left in the middle of the page, the median stock in our universe is trading at about 20 times our 12-month share earnings estimate to June 2018. This is a good time to mention that Value Line's estimates are created completely in-house by our research team. Our PE calculation is also different than many other research houses. More specifically, we use a combination of reported figures and estimates for our PE ratios, which we think is better than using trailing figure or just estimates. The PE at 20 on a historical basis is high, but is consistent with levels reached during other multi-year bull markets. For perspective, let's consider just how far we've come. The S&P 500 index is now valued at around 2,620. 5 years ago today, it was around 1,410. That is a gain of 85%. We think there are still plenty of worthwhile investment candidates, but at these levels, there are surely a great number of overvalued stocks. So it is vital that we separate the good from the bad. For our search, I'm going to include price to earnings as one of my criteria. Let's also take note of the median dividend yield of 2%. If stocks are indeed pricey, then price appreciation potential may be harder to come by. Thus, dividends may well prove useful in order to fuel total returns. Let's now go to the screener and find some candidates. This important investment tool can be accessed via the Find Ideas tab at the top of our website. Subscribers have access to more than a dozen preset screens, as well as 50 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available for higher level subscriptions. I'm now going to run a screen. Since we discussed it earlier, and it's important, let's start with price to earnings. To fill this out, I can do this in a couple of ways. I can use the sliding bar to set my range, or I can type the values in the from and to boxes. As mentioned, the median is 19.9, so I'm going to focus on stocks that are currently trading below that level. So I'm going to type 19.9 into the to box. I also want to remove stocks that are trading at very low multiples, which often implies that something, besides earnings, is impacting the stock. That can be a legal matter, recent management turmoil, or signify an industry that is currently out of favor. Thus, I'm going to set the low bound to 5. This will also remove unprofitable companies. Okay, that's a good start. We just went from 5,000 matches to 1,000. Let's now add dividend yield. And I only want to focus on companies that pay above average, have above average yields. I'm going to set the low range to 2.0. Next, I want to focus on a key phrase of Harvey Katz's write-up, and I quote, "A careful approach to equities is warranted, with particular emphasis on the selection of quality names with supportive earnings." The first part sounds like we should add a field that will provide some defensive properties. There are numerous risk and volatility measures, with beta probably being the most popular. However, I'm going to utilize ValueLine's proprietary safety ranks. The safety ranks measure the total risk of a stock and is arranged on an easy-to-understand 1 to 5 scale, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. For this, let's focus on stocks that have risk profiles that are better than average. So I'm going to select 1 and 2. Only the largest, most financially strong companies earn top marks for safety. So this should also help satisfy the quality names part of the equation. Let's now move to earnings. I want to make sure that the companies I isolate have been performing well of late and growing their bottom line. For this, I'm going to use the EPS growth rate for 5 years field. And I'm going to set my lower bound to 15, which represents a significant level of annual advancement. All right, that gets us to 12 stocks. I'm going to add one more field to my screen, which will ensure that we are generating a list of stocks that should do relatively well over the long term. The projected 3 to 5 year annual % low total return field, which I know is a mouthful, helps target such stocks that are expected to generate positive returns. For this, I'm going to set my lower bound to 8%, which is a healthy annual level for stocks on a historical basis. And there we go, 4 candidates. According to our criteria, these should suit an equity portfolio that wants to focus on reasonably valued stocks that offer dividends, above average levels of safety, without sacrificing too much total return prospects. Before I move on, please note that users can save screens and revisit them later by utilizing the button at the top. If you're like me, you tend to watch a bunch of stocks for a few days or weeks before seriously considering taking a position. ValueLine's watchlist tool makes this easy. I can access watchlists from the menu above or from Browse Research, which I'm going to now. To save time, I've already created the watchlist for these stocks, but the process is quick and easy. Before I move on, I want to briefly mention a new website enhancement that we recently rolled out. As you can see on the watchlist, we provide quick access to our classic PDF reports. These links are now available on all lists, including the VLS current issue, Dow 30, analyst covered stocks, etc. Of these stocks, I'm recommending a closer look at Discover Financial, ticker DFS. Let's see why. Clicking on the company name will take us to the equities digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, and hidden, so you can create your own customized stock report. For instance, let's say I'm most interested in the analyst commentary. I can simply click and drag that box to the top. In addition, now I want to see more ranks-related information. For that, I simply click on the larger rectangle in the heading. Once I alter the presentation to my liking, I can save the changes from the sliding horizontal action bar. The next time I come to this stock report, it will look the way I set it up. Let's first get some quick information about Discover's business. So I'm going to scroll down to the business overview section. As you can see, the Illinois headquartered corporation is a direct banking and payment services company. It offers credit card, personal loan, and deposit products. It also operates the Pulse ATM/debit network, which serves more than 4,100 financial institutions and includes over 850,000 ATMs, as well as point-of-sale terminals nationwide. It has more than 15,000 employees, and officers/directors own 1% of the common stock. Let's now take a look at Discover's recent price action. From the valuation module, I can quickly pull up a stock chart. The yellow line is the equity's performance. As you can see, it advanced sharply at the end of 2016 and earlier this year, but then retreated and appears to now be getting back on track. I'm now going to take a look at the analyst commentary to get some information in regard to what is going on at Discover. Editorial analyst Kenneth DeFranco mentioned the following in his most recent full report. Shares of Discover Financial Services have jumped approximately 10% in value since our August review. Once again, the company's bottom line appears to be trending in the right direction, and investors have taken notice, bidding this issue up accordingly. Broad-based loan growth and margin expansion have been the key factors behind Discover's improved performance of late. The top line has been fueled by strengthening demand for merchandise revolving credit accounts, a revamped rewards program, student loans, and consumer lending products. In addition, loftier interest rates and more stringent expense controls have helped bolster profits. I now want to show you our classic PDF report, which is included with a digital subscription, and provide some analysis on why we think Discover will perform well, and the stock will trade between $85 and $115 by the 2020-22 timeframe. Accessing the PDF can be completed via the tab in the gray bar. Going back to Ken's commentary, the payments network has shown renewed signs of life. Proprietary volume rose roughly 6% year to year in the latest September term, primarily driven by a rise in active Discover card accounts. Meantime, Pulse volume soared around 17% over the same span, thanks to elevated usage of Diners Club and newer franchise accounts. Finally, network partners experienced a 15% bump, with the addition of Ariba Pay accounting for the bulk of that gain. As for the stock, Mr. DeFranco summed it up quite nice with, investors may want to place this equity on their radars. The good quality stock offers accounts a decent source of risk-adjusted total return potential out to the 2020-2022 timeframe. Further, the issue still seems fairly priced despite its recent climb, meaning it may not be too late for value hunters to hop on board here. We believe Discover's size and market share will allow it to overcome short-term obstacles and capitalize on solid new account growth over the long haul. That investment advice sounds a lot like Harvey Katz's conclusion and appears that DFS checks a lot of boxes. It is a large, well-known company. It appears reasonably priced in an expensive market. It's relatively safe. It offers a decent dividend yield. Earnings are on an upward trajectory. And 3 to 5 year total return prospects are quite favorable. All told, in our opinion, Discover Financial, ticker DFS, is one stock to buy right now. I want to quickly highlight another useful investor tool, the Alerts Hub, which can be accessed via the Find Ideas tab. Users can set up notifications and receive an email or text message when a notable event occurs for a specific stock. As you can see, I have a few already set up. You can set up alerts for a variety of events, including when the price of a stock moves considerably, when there is a trading volume spike, or when Value Line changes the rank of a particular stock. In total, more than 15 alert functions are present. I'm going to quickly set up an alert for Discover just to show you how easy it is. First, type in the ticker and select stock. And just for this, I want to be notified the next time Value Line puts out a report. So under the Analyst Update section, so Analyst Review, and I want to be emailed. And once you close that out, as you can see, it's been added to my list. I hope you found the method for finding a stock to buy right now interesting, informative, and efficient. I do also want to point out, however, that ValueLine offers a variety of model portfolios that can help alleviate the work of finding worthwhile investment candidates altogether. Part of the ValueLine Investment Survey is the weekly selection and opinion newsletter. Along with economic and stock market commentary, are 4 model portfolios. Each one is a different investment strategy, is actively managed, updated each week, and always contain 20 stocks. The portfolios are overseen by senior research analysts. As I mentioned, they're in the selection and opinion. Each week, they get a full write-up, and the corresponding tables are below. And with that is the end of my formal presentation. Let me go back to the homepage, and I will take a look at your question. All right, first one. I'll read out the question, and then I'll do my best to answer it. What is your opinion on what is going on at General Electric? Investor confidence seems to have fallen with the new administration. All right, I don't personally cover General Electric, but of course I'm familiar with what's going on. They're obviously dealing with some hard times, and the stock has hit new multi-year lows. There's even rumors that they will be removed from the Dow Jones Industrial Average. It seems like, I would say, management is on the right track, but they have a long way to go to get that back up and running and having GE, go back to being the powerhouse that it once was. I would you know what? Why don't we take a look at our last GE report and get an idea? As you can see, just right off the bat, it's currently ranked 4 for timeliness, which means that's in a below average mark, and we think it will lag the year ahead market. So from our strictly quantitative side, we don't think it's going to be a very good performer over the near term. We quickly take a look at the last report. This is already a few weeks old, admittedly. The stock is nowhere. Stock's now 1950. We have written, as you can see, a ton of supplementary reports. And these are available for subscribers and for non-subscribers. We provide free research on the Dow 30. All right, next question. Here's another question about timeless. I mentioned this G right there. Do you use timeless in your screen, and how would you use it? Let me go back to the screener. Obviously, I did not use timeless in my particular screen today, but I usually do. For those that don't know, ValueLine has been ranking stocks for timeliness since the mid-1960s. It's a purely quantitative formula. It's on the same 1 to 5 scale as safety, 1 being best, 5 being worst. And the 1s and 2s we think will outperform the broader market over the next 6 to 12 months. And as you can see, it's a field in the screener. What a lot of people do, if they're looking for stocks over the relatively near term, they would start their screen by just looking at the 1s and 2s. It's a forced bell curve, so there's always 400 1s and 2s, 100 1s and 300 2s. So people would start here and then obviously add in additional criteria. Has anyone ever looked retrospectively at VL price predictions to see how accurate they are? Yes, we've done some internal studies in regard to one particular number, which I'm going to show you. Going back to the summary index, you'll see this estimated median price appreciation potential number, which is currently 30%. So we think that the median stock that we cover will increase in price 30% out 3 to 5 years, which is the 2020 to 2022 timeframe, which I've referenced a couple times. Just to show you, during the market low, that percentage went as high as 185%. We've looked at this number in depth, and it actually has been a pretty good indicator for the market going forward. It's a really good kind of a validator for where we think the market is now. Historically, 30% is quite low. Our average is closer to 50%. There's actually been several Market Watch and Wall Street Journal articles written about that percentage, and those are on Google if you want more information. Where can I find a history of timeless rankings for a stock? You can actually see that in the module. So if we go back to Discover, for instance, if you want the history of the ranks, you can look at what it was over the past year, the last 4 PDFs. We also provide the last 13 weeks of issues and the summary index, so you can see how the ranks have changed week to week. Is there a simpler way to find the stock with good or high returns? Another way, if you don't want to utilize the screener, in the back of the summary index, there are actually a bunch of preset screens. So for ones with high total returns, here are the stocks with the highest 3 to 5 year price appreciation. As you can see, number 1 on the list, I'm going to make this a little bigger for everybody. Number 1 on the list is Tahoe Resources. As you can see, we think it's going to go up potentially by over 400%, but you'll notice that it has a poor timeless rank and the lowest rank for safety. So you'll notice that stocks with the largest potential